Hi there, welcome back to ET Now. You're watching Buy Now, Sell Now, and today we have a very special management joining us, Nilesh Kambli, CFO at Star Health and Allied Insurance. Hi Nilesh, thank you so much for joining us. Good morning. Let's talk about your results. Then, now can you demonstrate first up the strong growth on net earned premium given the GST cuts that were announced just in September? Now, does it change your aspiration for FY26?
Yes, we have seen a positive growth when it comes to retail health business. We have seen a fresh growth upwards of 20%. We see some improvement in persistency of our back book or renewable portfolio, as we call it. In terms of loss ratio, we have seen a reduction when it comes to Q2, and which is where the fresh mix in the overall mix of business is improving. When it comes to earned premium growth, yes, we are seeing a growth in the earned premium because that's a direct correlation to the GWP growth that we see. And we see a good momentum going forward when it comes to fresh business growth as well as improvement in the loss ratios and expense ratios.
All right, Mr. Nilesh, I want to understand, does the entire industry grow faster because of the lower GST? How can you explain the rationale behind this?
Very difficult to comment on other players, and especially when 1/N was implemented, and September it was only effective for 9 days. But for us, if you have to talk about it, we see a very good momentum both on the count of policies increase as well as the growth in the premium for the month of October as we stand today. It's upwards of 45% when it comes to GWP growth. We see a good momentum for us, and we believe it should be positive for the industry as well because the reduction of 18% GST and the entire benefit is being passed on to the customers. One more point to note is, there is a change in customer behavior also. That is what we are seeing. 18% GST implies that it's a comfort or a luxury product. But when it is brought to zero, I think the communication is it's a bare necessity now. Only food grains are at 0% GST. So we see some shift in the consumer behavior, and we believe this momentum will continue.
All right, but since we are talking about the industry, tell us, where are you placed? Do you grow faster than the industry, and you hold a large market share, that is? So what's the scope for further expansion? Is that a priority for you right now?
We have grown in line with the market. We continue to maintain our market share of 32% when it comes to H1 2026. While we continue to grow faster, we have maintained that we'll grow only in the preferred segments, and certain high loss ratio geographies we are slowing down or exiting those markets. We have brought in some underwriting controls in these places. So profitable growth is the agenda for us. As long as it meets our ROE thresholds, we are happy to grow, but it's not growth just for the sake of market share is what we see as our strategy.
Let's also understand the way claim ratios are playing out, How do you think the claim ratios are playing out versus what you had penciled in? Any changes in that kind of reference?
So claim ratio for Q2 when it comes to retail business, has come down. For the company as a whole, we have seen a reduction of 1.9% claim ratio reduction. So it's a substantial reduction, and Q2 seasonally is a high loss ratio quarter because of the fever and infectious diseases. We have seen a good improvement thanks to our underwriting strategy of writing profitable businesses. The wellness work that we have done through home healthcare, through telemedicine setup, the fraud, waste, and abuse. We now have AI/ML models to identify this fraud-prone healthcare providers, customers. So all these benefits, by bringing in good systems, by bringing in good processes, we are able to control the loss ratio, and we believe it will continue in the future as well.
All right, so that's about the claims ratio. But Nilesh, what about levers that you are going to use to bring down the combined ratio down below 100? How quickly do you think you're going to be able to get there?
We are working towards it. The price increases that they have taken in the last year, the expense ratio benefit through employee productivity, as I just mentioned. We don't want to give any specific guidance, but we have maintained that for FY28, our ROEs will be in the high, teens ROE, and we are working towards it. Our investment portfolio consistently is delivering 8.25% investment return, with a mix of fixed income and equity portfolio. So a good improvement in the combined ratio as well as a robust investment return, we believe that we are on the path towards achieving a high teens ROE.
That will be all. Thank you so much, Mr. Kambli, for joining in and talking to us today.